welcome to our first episode of our new podcast. Today we're tackling a topic that's top of mind for any prospective home buyer, and that is the deposit. How much do you actually need? We're going to talk about first home buyers and how they rustle together their deposit, but we'll also talk about downsizers and perhaps people looking to buy or to upgrade their home or to buy an investment property. I've got with me Vish Kanu. Vish, welcome, mate.
Thank you. It's good to be here. This setup's pretty cool.
It's pretty fresh.
For our first attempt. So pretty keen to get stuck in.
No worries. Let's fly straight into it. Now, traditionally, 20% is the gold standard deposit requirement. Is that still the case?
If we're talking gold standard,
Yeah.
it still is somewhat relevant. However, there's plenty of other options out there to help people get into their first home, upgrade, investment property, whatever the case is. So I think it's just important to understand that is still kind of the gold standard, but there's plenty of other options available to people.
Sure. And in terms of having a lower deposit, does that inhibit the possibility of purchasing a property, or is it still possible with less than 20?
No, it absolutely is
Yep.
less possible with less than a 20% deposit. Typically speaking, some lenders for owner-occupied properties may even go up to as much as 95% of what the property's worth, 90% of what the property's worth. But typically speaking, as soon as you do go to those types of levels, if you're just not a first home buyer, not eligible for certain schemes, there is an element of lender's mortgage insurance that you've got to pay.
So on that, two things. First of all, does it vary from lender to lender on what deposit requirement they need?
It will,
Yeah.
depending on their policy. It will change slightly. And I guess also change depending on the type of property that you're buying. So a lender may be willing to give you more money to purchase a home versus an apartment, for example.
Sure. Okay. Second part of that was you mentioned schemes. So we jump into the first home buyer stuff now. There's a few schemes available, and these ones are actually pretty good because in the past, the intention was probably pretty good, if you remember the shared equity scheme from 100 years ago, if you're old like me.
I was just about to say I'm not old like
yeah,
you,
thanks.
so probably don't know those ones.
But the recent schemes from the government actually been pretty good, haven't they? They've been pretty helpful, particularly the guarantee scheme.
Yeah, spot on. So the guarantee scheme is a federal government scheme that's available to all Australians and permanent residents at the moment, and that's a sort of a flat scheme, irrespective of which state you live in. So you can get into your first home with as little as a 5% deposit. You avoid the lender's mortgage insurance, which I mentioned before, and you get access to competitive rates, almost as if you're a 20% deposit holder if we're talking about gold standards. So that's at a federal level. There are certain eligibility criteria involved with that. There's income thresholds, there's property value thresholds, dependent on the state in which you are buying in. But it is a great way to get into the market for first home buyers.
And in terms of the actual administration of that, it's actually pretty good to reserve a spot in that scheme and actually execute a property transaction, isn't it?
Yeah, absolutely. I mean, first thing to note is that not all lenders have access to the scheme.
Yep.
They got to register, and it's only a few lenders that make it available. But in terms of administration, it's really just one form that gets witnessed by a certified witness, and providing the evidence that you meet the eligibility criteria. This gets done as part of your loan application to the bank, and it basically gets approved at the same time.
So good.
Yeah,
So clean.
really, it is really good.
So we talked about the federal first home buyer schemes. Take it down to state level, WA for us, obviously, but what's available in WA for first home buyers?
So in WA, there's the state government scheme where there's two options basically. If you're a first home buyer that's looking to construct your first home, you will get a stamp duty exemption depending on how much the block of land is specifically. And if you're building a new home or actually moving into a property that's never been lived in before, you will also get a $10,000 first homeowners grant available to you, which can get paid at sort of different times dependent on the bank. And then if you're buying an established property as a first home buyer, there's a stamp duty concession. Now, at this point, there's been some very recent changes with some changes to the amounts. So to give you an example, if you're buying an established home in the Perth region, anything under $500,000, you effectively pay no stamp duty. And anything between $500,000 and $700,000, it's tiered. So anything above 700, you basically pay full stamp
Full
duty.
rate.
Yeah, exactly. So that's WA specific.
Sure.
Most states, if not all of them, have their own level of support for first home buyers.
Yep.
So it's really important to understand, depending on where you're buying, exactly what benefit you're going to get as a first home buyer.
Sure. Work out what you're eligible for before you jump into the market.
Exactly.
Cool.
Yeah.
If those schemes aren't available to you and you've got less than 20%, you're going to be in, like you said, mortgage insurance territory.
Yep.
How savage is mortgage insurance these days? Is it as expensive as it used to be, or is it, does it vary bank to bank, for example?
Again, it really depends. There is going to be slight variations between bank to bank, but I wouldn't say like it's a massive difference in terms of the actual dollar amount. What will impact the dollar amount is, if you're borrowing 90% of what a property's worth, for example, versus 95%, then the LMI will be different.
Yeah.
To give a really rough gauge, and definitely don't hold me on these, but on a $500,000 loan at 90%, you may be paying lender's mortgage insurance in the vicinity of $7,000 to $9,000.
Gotcha.
Whereas if you jump up to 95%, that may double.
Yep.
So just important to take note of that.
Sure. Just on the LMI, let's just unpack that for a second. What does it stand for, and what actually is it?
Yeah, so we were just discussing about the gold standard being the 20% deposit amount. So if you're not eligible for certain schemes and other options, then if you've got less than a 20% deposit, you potentially have to pay LMI or lender's mortgage insurance. So lender's mortgage insurance is basically a fee that gets charged to borrowers. It gets capitalized to your loan. So meaning to say that it gets added onto your loan amount.
Yep.
And it's not actually to protect the buyer or the borrower. It's to protect the lender. Because banks or lenders consider that if you've got less than a 20% deposit, you're effectively a higher risk to the bank.
Sure.
In terms of an equity position, but also, your previous history in terms of savings ability and whatnot. So it's like I said, it gets added onto your loan. How does it kind of impact you both in the short term and long term? Because it's added onto your loan, you're obviously paying interest on it for the life of the loan. And eventually when you do sell it, for example, or if you look at accessing equity in the future, you've lost that bit of equity by having that. We always say to clients, though, that LMI is an opportunity cost, and you just need to consider it. It's like, okay, if I pay an extra $8,000 in LMI up front and pay the interest over the life of the loan, would I have been better getting into the market at that point in time and copping that cost over the long term if my property appreciates in value? You just got to weigh that up, and that's a conversation that we'll have with clients about LMI.
If you're in the position where you've got a guarantor available, now guarantor loans are nowhere near as scary as they used to be. Again, I've cited the good old days, but they're pretty straightforward. They're limited liability guarantor schemes. Are they still popular? Are we using them a lot these days?
Yeah, so the family guarantee scheme, which some lenders offer, is another great alternative to people that don't have a gold standard 20% deposit. What it basically allows people to do if they've got a willing and able guarantor, be that their parents, grandparents, basically first line relatives.
Yep.
If they've got already owned property that has sufficient equity in their property, they can essentially provide that sufficient equity as additional guarantee for your purchase. What that effectively means is that it takes away the requirement for you to potentially put in any cash at all, which is a pretty exciting opportunity if you are struggling to get into the market.
And with those guarantees, you're also going to get access to all the best loan products too, aren't you? So you avoid mortgage insurance, you get access to really good rates, and your deposit requirement is minimal, really, if at all, for some purchases. So
exactly right. It probably acts in a similar way to the federal government scheme that we were just discussing, in that you avoid the lender's mortgage insurance completely and you get access to rates and products as if you're an 80% borrower. It is obviously very important that we have those conversations with the guarantor, though, in those instances, to make sure that they're a suitable and effective guarantor, and we're not actually putting anyone in a position that they don't want to be.
the old sleep at night test.
Yeah.
Make sure everyone's comfortable with it.
Exactly right. Exactly right.
In terms of removing that guarantee,
Yeah.
it's hard to put a time frame on that, but we're looking for basically equity in the place and for the clients to pay down the debt, really, aren't we?
Correct. So the people that are borrowing and purchasing the property, if you could be borrowing up to 100% of what you're buying, right? Which can be quite a scary thing. What that means from a serviceability perspective as well, and repayment perspective, is that you're paying 100% of the loan.
Sure.
As the borrower. So the guarantor has no responsibility to pay that debt. So ideally, you want to try and remove that guarantee as soon as possible. And like you've rightfully pointed out, it'll be a combination of two things. Either the value of the property increasing, or them paying down debt, or a combination of both. So to give you an example, if someone bought a $500,000 property and they borrowed the full $500,000 up front using this guarantor option, for argument's sake, let's just say they had circa 30 to 40 grand cash, which they were willing to use. So they used that to contribute towards their stamp duty and other costs. So they're sitting with a $500,000 loan against a property that's worth $500,000. Sure. In 18 months' time, the market has moved upwards and the valuation of the property is worth $600,000, for example. In that time, they've also paid off $20,000. So doing some really quick maths in my head.
I was going to hit you up for the maths on that, yeah.
480 grand loan against a now $600,000 property basically then gets you to an 80% loan to value ratio.
Nice.
It'll be at that point in time where we'll effectively try and remove that guarantee to remove that liability, and basically you've then got an 80% loan, and you're pretty much in a pretty strong position from an equity perspective as well. Yeah.
And it's pretty much as simple as getting a valuation done and removing the mortgage.
Exactly right.
Cool.
Yeah.
Typical.
Again, valuation, one form,
easy, potentially
a refinance, and away you go.
Let's look now at existing homeowners. So first of all, people are looking to upgrade their home, because that's particularly with downsizers. I'll say upgrade, but it's also for downsizers in this market where people have the big family home looking to downsize to something a bit more manageable. With a tight property market, it's meant that's been quite tricky. So how are we using equity in the existing property as deposit for that next purchase?
So yeah, if you've got an existing property that you're planning on converting to an investment to then upgrade, a lot of people have equity in those existing properties from a combination of increase in value as well as paying down debt over time. What we can look at doing is basically accessing one's 20% deposit and costs for a prospective purchase from their existing property. And that effectively becomes cash in hand for you to then put down as your 20% deposit and costs, and then you therefore borrow 80% of your new property, or the gold standard, I should say.
The 20%,
yeah. So that's probably the key way in which we're doing it. Another way is a bridging loan, which has become...
They're back bridging,
They are. That's something that's really come back into the market simply because, like you've said, the stock is so tightly held at the moment, especially in places like WA. So the bridging loan effectively gives you the ability to potentially buy without selling your existing home if you need to go down that path. Again, there's some pretty key criteria with that. So that's something that's going to be relevant to people's situation.
Similar vibe to the upgraders or the downsizers, but the investor market, using equity in the existing place. We touched on it a second ago, but structuring that right and getting the deposit and cost loan, like you said, that's still tax deductible, isn't it, for the purpose of the purchase?
It is. Yeah. When it comes to tax, we always advise people to speak to their accountants, but we have pretty good experience in setting this up and dealing with clients' advisors. So when it comes to investment properties, using the similar example to upgrading before, the way we would structure it is exactly the same. Yeah. So you've got someone that owns an existing home, they're living in it, they want to buy an investment property. If they've got the equity available, we'll create a new loan split against their home, which again basically just releases cash into their pocket. They then use that cash to go and put down as a 20% deposit and cost on an investment property purchase, and likewise borrow 80% against the investment property. Now, even though that 20% has been released and is secured against their owner-occupied home, you should be able to claim the interest on that debt, because tax usually comes down to purpose of funds, not what it's secured against.
Sure.
But again, that's something that everyone should double check with their accountant to make sure it's an effective strategy for them.
It's also probably why we have the conversation with clients up front around, you're buying your first home.
Yeah.
Is there a possibility that in 5 years' time you're going to upgrade that? And if so, will you keep that as an investment? Because that changes the way we structure the debt on that, really, doesn't it?
100%.
Make sure we're preserving any future tax deductibility.
Exactly right. It's not just it's preserving tax deductibility is probably one of the key things, because then it's also thinking about offset accounts and whatnot as well.
Yeah.
That's really a conversation that we have with them up front. Which, and then again, tying it back to deposit amounts, your purpose of what it is that you're looking to buy, what's your plan. We kind of factor that all in when we kind of advise the best course of action.
And it's still, that first one is the hardest one, isn't it, really? Because then you've got a combination of savings, equity, other debt that you've paid down. You've got a bit more scope to purchase that next place or upgrade from there, really, don't you?
Exactly, yeah. I mean, we always say this to clients as well. Your first property tends to be the most important one, because, especially if you've got aspirations of building a portfolio or creating wealth, not just through property. If you get it right the first time, it does make it easier to accumulate that as time goes on.
Yeah, huge. Vish, we're just about out of time. Before we sign off, what's your one killer piece of advice for people grappling with their deposit for a house?
Yeah, I want to be careful and not give specific advice. And I think it's pretty clear, because there's options out there. Whether you're a first home buyer, you're an upgrader, you're a downsizer, you're looking at buying an investment property. When it comes to deposits, there are options. So it's the one key thing is really understanding what those options are.
Sure.
So that you can make the best decision for yourselves, not only now, but moving forward. So speak to your advisor.
Get in touch.
What I'd say.
Yeah. Nice. Beautiful. That's all we've got time for this episode. Vish, thanks very much for joining me.
No, it was really good to be here. It was a bit of fun, even though it was the first time. And hopefully people got some handy information.
No, appreciate it. You got through it well. Thank you, mate. And thanks everyone for watching.